Pack this for you. Good morning. Shall we begin? Good morning to you all, and thank you for coming. I think we didn't realize it's a bank holiday today, but it seems to be an easier one for people in terms of the road commute. The stock markets are working, and I think thank you for coming for our second Capital Market Day. I would also take this opportunity to sort of welcome all the staff of Indian Hotels who are watching through a webcast. So potentially, if everybody logs in, it's about 30,000 employees who will watch this webcast actually. Let's see how many people do that. We are looking forward to that. We have with us, it's going to be a program for maybe about 2 hours or so. We have, in terms of the agenda for the day, what we have is that we begin with Vijay Thakkar, unlike last year, where it was us speaking as a management team. This year we have invited 2 experts to come and speak to us. One is Vijay, who represents Horwath, who will talk to us about the Indian hospitality. We also have Paul Slattery, who has come from London. He represents Otis and Company, which has deep hospitality experience, and he'll give a little bit of the perspective on the international operations. And in the team, we have the executive committee of IHCL. In addition to Puneet Chatwal, our managing director, we have PV Murthy, our HR director. We have Rohit Khosla sitting on this table, who heads our north and the west operations. We have Prabhat Verma, who heads our South India and international operations. We have Rajan Mishra, who is our general counsel. We also have Suma Venkatesh, who heads our development. We have Deepika Rao, who heads Ginger. And we have Sagar Dige, who heads our Taj Sats. And of course, we have Renu Basu, who heads our sales and marketing. So without further ado, I think we should begin the proceedings, and may I request Vijay to come on stage. Thank you.
Good morning, everybody. I'll tell you a bit of a secret. You know, everybody talks about achhe din. Everybody looks for achhe din. Hoteliers actually look for achhi raat. And don't get any wrong ideas. No. If the hotel is fully occupied that night, if you had a lot of room nights sold, not vacant, sold, for us it's an achhi raat. And that achhi raat then translates into achhe din. So the good thing is that in 2018, we have all had much better raats than in the earlier years. The industry has done. If you look at year-to-year comparison, full report to full report, you'll say, listen, it's up by 0.2. What's the great difference? But actually, you need to take out all that has been added in the year because it's been added at different points of time. If you do a like-to-like comparison, what we call a same store, occupancy went up by almost 1.7 points to 67%. Rates went up too, and therefore have RevPAR. So the trend has been very good in the context of what it was in the past. Of course, it can be better, but the movement has been extremely positive. Now, I'm going to start with some key factors, small, briefly touch upon them and then go into some more detail. And why do I call out Bangalore? Because as a single city, it now has the largest inventory of chain-affiliated hotel rooms in India. It's crossed an inventory level of 14,000. Delhi follows. Mumbai is third. Mumbai used to lead along with Delhi. And what that tells you is that that market, which still continues to, last year it was the only major market that got sizable inventory addition, which partly impacted its results. But what it tells you is that that market is growing in so many different geographical directions that the dynamics of hoteliering in that market and other markets that are similarly placed could change over a period of time. Bangalore, as I said, in the typical situation, a lot of supply addition, you would see occupancy decline and sharp rate decline, or at least a rate stagnancy. Bangalore hasn't done that. They've had an occupancy decline because they added almost 1,400 rooms, but they grew their rates very sharply. And that was a very positive thing for Bangalore for the first time. Pune, a market I've always believed in, helped by the proximity to Mumbai, crossed the 70% occupancy level and has continued to grow rates in a positive fashion. Delhi has gained substantially thanks to the GST. GST has leveled out the tax element between Gurgaon and Delhi. Earlier, Delhi had a very usurious luxury tax, so Gurgaon was benefiting because of lower luxury tax. Now that it's a level playing field, people prefer to come back and stay in Delhi. People prefer to use the hotel facilities and the banquet facilities in Delhi. And that has helped Delhi in a very substantial way. Again, Delhi, for the first time in many years, has crossed a 70% occupancy level. And overall, it's a positive RevPAR story. If you see all India, it's a plus 2%. New Delhi, 11.6%. Pune, 11.1%. Bangalore, plus 2.8% in spite of an occupancy drop because of new supply. Mumbai, 5%. So, and again, I'll look to the east, the only city we have in the east, Kolkata, plus 1.5%. That city does not have sustained corporate growth, but it has a lot of MICE business. It's benefited from football. It's benefited from other events that are being hosted in the city. And it's managing to retain growth, or at least a steady performance in tough years when supply addition continues to occur. Hyderabad has grown almost more than 8%. Again, a city that is seeing sharp business revival. If you see Cyberabad, spaces are being taken up as they are being announced. I thought I'd highlight to you some of the achievements in this year in terms of markets. So what I've said is that in 2018, the results in terms of occupancy and ADR for the whole market, and then again for the luxury upper upscale segment that is most relevant to Indian hotels. In India, on an all India basis, market-wide, the 2018 results were the highest in the last 10 years. And you will see 10 in 12 of the 28 fields, which means that in 12 instances, the results have been the highest in the last 10 years. Now, if I take out Bangalore and Goa, Bangalore, I told you, has been an aberration, down on occupancy, up on rate, but obviously not at the highest levels. So if I take that out, and I take out Goa, which is going through, I think, a period of rationalization. There's been a lot of new supply that's come in there. There is an element of rationalization as GST has impacted a little bit of the weddings business, as the charter operations change. But Goa has continued to grow rate. It's the highest rate still in the country. So in the luxury upper upscale segment, sorry. So if I take out those four, and therefore 28 becomes 24, fields, 50% of that is a 10 on 10. And that's, I think, a very important thing. In most other markets, it's 5 or above, a lot of 7s, some 8s, 1 9. So it's been a healthy performance compared to the last 10 years. This is a chart which we like to use on the x-axis is the occupancy, where if you've got more than 80% occupancy, you're strong. If you're between 70 and 80, you're busy. On the y-axis is the rate, and this is market-wide. If you're more than between 7 and 9,000, you're superior. If you're more than 9,000, you're healthy. Now, unfortunately, at this point, nobody is strong and healthy. Mumbai is busy and superior, which means Mumbai has got occupancy above the 75% or thereabouts. Delhi, Pune have moved in the busy range this year. Goa continues to be in the superior rate category, but has marginally declined on the left on the occupancy side. Unfortunately, there's a lot in the middle. I've said this before, the Indian physique, bulky in the middle, that's reflected here as well. Let's look at the luxury upper upscale performance across the country again. Across key markets. Mumbai, way to the right. Busy and a good rate, touching 9,500, just under. Goa, rate crossing 10,700, but a little bit to the left on the occupancy side as compared to what would be desired. Again, Pune and Delhi, on the right-hand side, with potential to go further, they need to pull up the rates. However, you look at metro markets, Chennai, Kolkata, Hyderabad, ADR's headroom to grow because they are all in the high sixes, or low to high sixes. Bangalore is doing well in terms of rate, but needs to move right on the occupancy side. Gurgaon is struggling at this point, but will come back. Jaipur needs to pull itself together because it's got too much of variation in supply size. Now, let's just look at the track. 2009, 27,000 hotel rooms demand, 52,000 hotel rooms supply. That was about a 52% occupancy share if you look at it. Supply kept growing while demand did not grow because of the 2009 to 2014 challenges. But that's started to change. 2015, it was 67 to 114, just about 60%. 2017, 83 to 133, just above 60% again. The gap is gradually narrowing and will continue to narrow because supply growth is still modest. The pace of supply growth has clearly slowed down. Supply growth could occur in the sense of the chain-affiliated hotels because there will be conversions from independent hotels to chain-affiliated hotels. Taj just announced a major one in Goa, where Siddharth Goa, which was an independent hotel, now becomes chain-affiliated and then comes into this count. But new hotel constructions have clearly slowed. If you look at the hotel segmental evolution, and why is this important? Why am I stressing on this so much? It may at the outset not sound very relevant, but it is. Because when you look at citywide results or at countrywide results, there's a tendency to say, oh, it's declined. But that decline may not be just because of the market. That decline may be because the composition of supply, the composition of what constitutes that number has changed. In 2009, 47% of the supply was in the luxury and upper upscale segment, and only 18% was mid-scale and economy. In 2018, what is the number? 16 and 19, 35. So it's 35% down from 47% at the top, and 23% up from 18% at the bottom. So, and that's on expanded numbers. We saw the expansion of numbers. So on that expanded number, if the mid-scale economy hotels, or therefore the middle-level hotels, have expanded their share of supply, obviously the market-wide result, the country-wide result, is going to start skewing down. So please bear that in mind. It's very important before you draw conclusions. You need to then dive down into cities and dive down into the respective segments, like we saw for the luxury upper upscale segment separately. Again, if you look at supply, the other factor which is going to be very important going forward, is that the major markets, which means the metros and some of the primary cities like Ahmedabad, Pune, Jaipur, Goa, Kochi, if you take those, the blue line will show you a growth in supply, a continuing growth in demand, and good performance. But what's important is the lower two lines. The other markets are starting to grow very substantially in terms of both supply and in terms of demand. Which means, again, your all India numbers are going to see a mix, a wider mix of non-major cities coming into the results and therefore impacting the overall results. Again, a factor to be borne in mind when you read and analyze reports. Again, just to explain that point, in 2008, Mumbai, Delhi, and Bangalore had 39% of the supply, and other markets had 31% of the supply. By 2022, Mumbai, Delhi, and Bangalore will have dropped to 33, and other markets will have gone up to 37, with the other key markets, which means 13 markets minus Mumbai, Delhi, and Bangalore, remaining at between 29, 31, 29%, so remaining pretty stagnant there. So quickly, what do we see for the future? I'd say very positive. Supply growth has slowed. Demand, macro factors supporting demand growth are strong and positive. The leisure sector is still substantially underserved, and there is a lot of demand in the market for leisure. So that is something that will help for those chains, those hotels that are present in leisure destinations, that will help those who are seeking to invest in the leisure sector. But overall supply will continue to grow. The only negative factor there is a lot of the growth is coming from the domestic market, not so much from the international market. When it comes from the domestic market, you get volumes, you don't always get good rates. The rate-paying propensity of the domestic market has improved, but still, relative to the international market, there's a gap. So a great benefit would be if we could actually draw, as a nation, more international travel into our country. MICE business, helped by convention centers or otherwise, will be a major player in future demand and operations. We have seen the benefit of hosting events in different cities, whether it's the Vibrant in Gujarat, whether it's the football that happened in Kolkata, Chennai, and partly in Goa. It's the hockey that happened in Bhubaneswar. Different events. If a city has events, it automatically draws business. And the power of that has been already shown, and hopefully with convention centers opening up in Mumbai, in the Pragati Maidan in Delhi, and in Dwarka over the next 2 or 3 years, that demand will continue to burgeon. As I said, there's potential to grow rates. The rates have moved in the right direction, but not as much as we would have liked to. As the markets improve with a 67% occupancy, we expect rates to now pick up pace unless we have external negative factors. And that's what I'm highlighting at the bottom. It's an election year. There might be some slowdown. There might be some impact. We don't know what. If that may be an external factor that, well, it could affect any industry. It could affect this industry as well. But I don't think as much, because I think that element has been discounted or will be discounted, because whichever way, travel will continue to happen because people will still want to grow business. Financing is, in fact, a little bit of a greater concern, because what it means is that new projects could get slowed down. Now, that may be good in the short term or the medium term for the industry, but in the long term, if you don't have continued addition or renewal effort because of a lack of money, that's not good from a qualitative perspective. And we do know that the banks and the NBFCs at this point are under some stress to lend to the sector. Airline sector stress, well, hopefully one airline has gotten over it. Hopefully the other airline will find enough pilots. But maybe that means that people stay in a destination longer, and that might be good for us. We don't know. That's it from me. positive message, I would say, in all. If you have any questions, I'll be around. Thank you.
Thank you, Vijay. I think may I request Paul Slattery to come on stage. Thank you. Yeah. Yeah.
Good morning, everyone. It's an honour to be invited and exciting. I'm going to be trying to introduce some interpretations of the international hotel business and to place India within the context of the international economies and the international hotel business, to give you some idea of what it looks like over the wall. And where I'm going to start. Sorry? It could be. It could be. Right, let's have a look at this. First of all, to give you some idea of the dynamic of the hotel business, here are the global major hotel chains and the growth that they have had in supply, well, since 1995. You'll know all of the names there. You're all from the investment community, so you will be able to work out the compound growth rate of that, but it's pretty damn good. This is an industry that's on the move around the world. It can't be stopped. It's exciting. It's changing the lives of people. It's changing the lives of investors. It's also changing within itself. Way back when I was an equity analyst, the big issue we had with hotel stocks was that most companies owned all of their hotels. And you needed a microscope to discover the returns that they were getting for their investors from that ownership. And so we moved towards an asset-light model of management contracts and franchises. The reason for doing that, hotel companies were unable to manage risk. And we thought if they were doing management contracts and franchises, risk-free, no problems, and we simply focus on accelerated international growth. And that's what you have here. They are not risk-free. Management contracts are not risk-free. If the hotel doesn't perform, the company doesn't get incentive payments. We get disgruntled owners, which most of you do not come in touch with. You don't come in touch with hotel owners who invest in hotels and don't get an effective return. I would ask you, I was speaking to someone earlier, I would ask you to go and look at the websites of some of the third-party hotel management companies, like Interstate Hotels, like Pyramid Hotels, RHM out of London, and look at their portfolios. You will find they're littered with Marriott hotels, with Hilton hotels, with IHG hotels, with Accor hotels, and these are all failed management contracts. So they are not risk-free. They can be exceedingly profitable. They are not risk-free. Hotel chains, and I'm delighted about it, are having now to think about other ways in which they can do business, in which they can evaluate risk, in which they can provide superior returns to their investors, other than simply by signing management contracts. It's understandable. For the past 20 years, we have had a fast market here. And as you all know, when you have fast markets, there's a greater propensity to make mistakes. Mistakes have been made. We now need and are looking for more balanced hotel companies that have got more balanced risk, who manage risk much better, who have more effective strategies for growth and for expansion. rather than simply saying, my pipeline is bigger than his pipeline, therefore I must be better. Here's a way to look at economies. We spend a lot of time on this. The worst use of your time is to consider questions that are common currency within the investment community. Where are we in the cycle? Or, worse still, hotels are cyclical. That's just a piece of intellectual laziness that means you don't need to do any work. Let's find out where in the cycle we are, and we can decide whether we're a buy or a sell. It doesn't work. It hasn't worked for private equity houses that have come into the hotel business. It hasn't worked for hedge funds who have come into the hotel business, who have more likely than not, and I can give you plenty of examples, bought in at the top of the market and sold at the bottom, rather than the other way around. There is a correlation, which is pretty powerful, between GDP per capita and the shape of an economy. You can see this here. We divide economies into 5 sectors. We have taken the tertiary sector, I'm assuming you all have done Economics 101. We've taken the tertiary sector and split it into 3. This is self-evident. Service businesses, financial services, retailing, professional services, communication services, and this baby here. This is us. Experience businesses. All hospitality, all travel, sports playing, sports spectating, cinemas, theatres, all cultural events. These are places you go to, they are real estate, you consume, and you leave. This is us. This is powerful. This is funky. Now, unless somebody's fallen asleep, you will notice a direct correlation between the GDP per capita and the share of GDP from the different sectors. And why do we think that's important? We think that's important because the next question we come on to do, and one of the things I'm engaged in at the moment, if you take an economy like India, what government policies, what corporate policies are required to move the economy in that direction? It's not rocket science. All of these guys have done it already. We know how to do it. And we need to, sadly, the people who know least about doing it are governments around the world. They have to be encouraged, they have to be spoken to, they have to be engaged with. And if we don't, we're not going to get them moving in this direction fast enough. It doesn't end there. Here's the same kind of thing, but related to employment structure. These numbers here are the share of national employment in each of the sectors. And it tells the exact same story. It tells the exact same story. And again, how does governments, how do corporates move in this direction here? This, ladies and gentlemen, is what economic progress is about. This is what we all want to see. This is why we do the jobs that we do. We need to encourage governments to get with the program. India's on the move. Your governments are doing something right. They're at the start of a voyage. And the fabulous thing is how they can keep it moving. What explains a lot of what Vijay was talking to you is the fact that the Indian economy is grounded in these two segments here, which are the lowest yielders for hotel demand. Difference, because they are the highest yielders of hotel demand. Service businesses and experienced business executives, particularly of international companies, spend as much time in the air than they do in the ground. In national companies, they spend much time traveling around that country as they do in their home office. That is manna from heaven for hotel companies, for travel companies, for restaurant companies, for airlines. Isn't it fabulous? Isn't it exciting to be living in a time when this change is occurring and you're party to it? Wow. A little measure that we use for every country in the world. And please note, citizens per hotel room. Look at the difference. It slides right into the previous two charts about the GDP per capita and the structure of employment and the structure of the economy. Now, again, here's a question that we ask. If the US has got 64 citizens for every hotel room, and hell, their hotel business is doing okay, what are the economic policies? What are the corporate policies that are required in India to move to that direction? It seems a huge mountain to climb, but it's not as huge as you imagine. For India to get that ratio of citizens per hotel room on the current population, are you ready for this? India would have to add 20 million hotel rooms. Isn't that just ridiculous? We could open a book on how long it's going to take for that to happen. Hell's bells, it's going to happen. And I'll explain to you in a second why it started and where it goes. But this is going to come down in leaps and bounds. It's not whether hotel companies or hotel developers have managed to weave their way through the maze of regulations to build a new hotel in India. It's because of the shape of the economy, because the economic policies, because the demand demands it. This is a big baby. Fastest growing export market in the world. I spent a lot of my time in the US and in the UK dealing with the ravages of Trump and of Brexit. And what both of them are trying to do is like King Canute and force back the tides. They're trying to force back this. Can't be done. Demand for experienced businesses is a powerful driver. A powerful driver. Can I ask you to just think for a second about your last vacation? You've probably forgotten about most of it. You see, when you're a customer in an experienced business, the only repeat gratification you can get once you leave is the memory. And there's a limit to how far the memory provides that gratification. And the only way you can get more gratification is to do it again, and again, and again. You can't turn this back. It keeps on going. Governments have to find better ways to penetrate this market. India has been doing well. They've been doing a damn sight better than the UK and a damn sight better than the US. But you've got a long, long way to go to get that volume up. But this is an addition to the domestic things that I've been talking about before. There's one offset. That is the growth in outbound tourism. The Indian economy, like all others, have to find more effective ways to manage the balance of trade in tourism. It's all very well welcoming people from around the world, but if you are like the UK and are running a 21 billion deficit in tourism because our government is so stupid about tourism that we've got many, many more people leaving and spending money outside the economy than they will allow in to spend money in the economy. This is a very direct feature that doesn't happen in many other sectors in terms of balance of payments. We know it, we see it every day in our businesses. I've talked about most of this. It's where you're going. It's unstoppable. Enjoy it. I feel I also have to say, since we're guests of one company at the moment, we have to say something about hotel chains and expanding. Domestic hotel chains have got a poor record. Let me give you an example. The last year I was an equity analyst, I published, as we did every year, a book on all the global publicly quoted hotel companies. And at that time, in Europe, there were 35 publicly quoted hotel companies which were national companies. That is, they only had hotels in one country. There are now 4 of those remaining. For a variety of reasons, they ran into the sand. They were too small, badly capitalized, badly managed, couldn't keep up, in the wrong places, and so on. The bigger you are, the more chances you have. The more international you are, the more interactions you have. You also need this. This is the current preoccupation for chief executives of major hotel companies, and we've got one in the room with us today, that you need to have multiple affiliations in order to expand and take advantage. And you need to have a hotel organization that is designed to evaluate that risk, to measure that risk, and to benefit from that risk. Enjoy the ride, ladies and gentlemen. It's going to be fabulous. Thank you.
Thank you. Thank you, Paul. May I now invite Mr. Puneet Chhatwal, the Managing Director and CEO of Indian Hotels, to start the presentation. Thank you.
Good morning. Paul, that was a fabulous last tagline, which said the companies that are best positioned would be both on the heavy and the light side. Just asset light, especially on the Indian subcontinent, is not a sustainable model. And just asset heavy, as we have learned, is also not a sustainable model. And that's why in the last Capital Market Day, we articulated our strategy, which we're going to repeat. I think I have a slide on my presentation. So firstly, a little recap. We are a pretty large group with $1 billion plus in revenue in 100 plus locations, 4 continents, 12 countries, having 4 hotel brands, several other brands on what we call under the umbrella of expressions, and many businesses which we've started treating like businesses in the last 12 months, and I'll take you through that, which are served tirelessly by our 33,000 employees every day, the ones who are responsible for providing the achhi raatein so that the next day we can have the achhe din. Approximately the total portfolio is 21,600 keys. So last year we showed the video, but I do see, and we had expected that, a lot of new faces in the room. I think instead of me talking all about the company, we have a short film of 3-4 minutes. So let's go through that, and that will give you a good idea of our portfolio, our brands, and in the direction that we are headed. So that gives you a good idea in terms of where we are headed. And as a reminder, we started and embarked on this journey of Aspiration 2022, saying this is where we are coming from, and this is where we are. And then we said, this is where we want to go to, keeping our fundamentals intact, staying true to our vision and strategy. And our vision and strategy was articulated in a very simplistic way. We are the most iconic. We want to make sure that we stay the most iconic hotel company that South Asia has ever produced. And at the same time, we added a connotation to it that we also want to be the most profitable company in this industry. So just iconic is not good enough. We want to be most profitable, but that comes at the top of the pyramid to have a solid foundation so that that is sustainable for a group like Tata of 150 years, for a group like IHCL for over 115 years. We wanted to stay true to our core values, the values of Tata's, but also the values of IHCL, which we use the word Taj, defining it as trust, awareness, and joy, having the trust of all our stakeholders, having the awareness of what is happening around us, very well articulated both by Vijay and Paul to give us a good start, and having joy in doing whatever we do. That takes us to the enablers, and we said the enablers are our strong brand equity. The enablers are our customers. The enablers are our high customer engagement. The enablers was, is, and will remain our market leadership position in various segments that we are in which no one is in. That's a proven track record of doing the palaces like no one has ever done before, doing safaris in India like no one has done before, introducing many other businesses which we are going to talk about. By doing three things, which we called it as reimagine, restructure, and re-engineer our portfolio to achieve our ultimate goal. This pyramid has kind of become a mantra or a Bible for all the 32,000 plus employees, and it's displayed in each of our properties and in each of our businesses, and we follow it very religiously. And to have the recap again, when we launched Aspiration 2022, we were having an EBITDA margin of 17%. We said we will grow this by 50%, which does not mean an EBITDA margin of 50%, but the 17 going to 25% over a business cycle of 5 years, right? And hopefully without a hockey stick effect, not that we will not do it this year so much or next year so much, everything is going to come in the second half of the 5-year cycle. Hopefully we will keep doing what we have been doing, and we come to the results in the later half of this presentation, and you'll see what we have done since we launched the Aspiration 2022. On the 3 R's as a recap, where we said we will restructure by scaling up the inventory, by selling the non-core assets, and also by simplifying our holding structure. It is very common for any company with 100 plus years history that over the years the structures get a bit complex for the quality of business that you're in. And we have, as you all are aware, several subsidiaries or associate companies that are further listed companies and have the same governance model as IHCL has, and that is something we are trying to simplify going forward. We will not succeed everywhere, and not everywhere it will be possible, but whatever is possible, we'll keep working on that. Reimagining of our brandscape that we have announced and communicated to you, that our brandscape has been segmented very, very fast, and the most noticeable change for you all should be, and for all our stakeholders, is that Taj has become the purest brand. We have the habit in emerging markets to put our strongest brand behind anything and everything, and that actually dilutes your engine. So there is no more Vivanta by Taj, or Taj Gateway Hotel, or Taj Salons, anything and everything. If you brand it as Taj, it gives you a short-term gain, but long-term, it actually dilutes your most important asset, And that's your brand name Taj in the IHCL portfolio. So we changed that on the brandscape. We said we'll multiply our portfolio. We said we'll maneuver excellence. Excellence is second to none. We'll continue to take it to a different level. We will expand our margins, which is the main part of our Aspiration 2022 story. We will embrace technology and continue to engage people. And it became an opportune moment to reimagine also, as some of the fundamentals, as demonstrated to you, were working in our favor. So the hospitality market was kind of turning around where the demand was outpacing the supply. So that is very critical. If the supply is outpacing the demand, then you have a different challenge. So you have to still reimagine, but you reimagine differently. And some of the factors is very critical that also hospitality professionals learn to know when to accelerate and when to decelerate. We accelerated here, if you look at this bottom that we hit after the GST and after the demonetization, somewhere in between, that's when the market started coming back in December 17 to March 18. 16th February last year was when we announced Aspiration 2022, and we went for aggressive growth, sales, marketing, pushing back, which eventually reflected in our results. Morgan Stanley estimates stood at full year 18 at that time at 6.7%, and for this year at 7.5%. Satyam, I wish you at least exceed this number, and we end up the year at 7.5 plus. So I think very good, robust growth, high disposable income, increasing affordability, and less headwinds other than those coming from building the wall or not building the wall or going across the wall, and some kind of trade issues that US and China are having. But the fundamentals of the business here are good. One thing that surprised me on Paul's slide was a very different story, that I learned something new today, that 80% of hotel rooms in the Indian subcontinent are chain affiliated, and only 20% independent. That makes India maybe the most branded hotel market of the world. And 67% were foreigners and only 33% domestic. Typically, I would have thought that in the majority of our big markets, 70% plus would be domestic and 30% would be related to foreign travel. But I think the challenge we have is a lot of these statistics get diluted at this point of time, because we have a lot of NRIs coming into India to visit families and parents, and for the sake of record, they are all counted as foreigners. So I think there is a challenge out there, and we need to use that data very carefully. Vijay showed this slide already. There's a 2% increase, but I think on the same store, this is something he only told us at his Horvath event, that when so much of supply is coming into the market, and it's not yet reached its year of stabilization, it's in the first, second, third year, it tends to dilute your average rate and occupancy. So the real growth on the same store, as you will see on all three variables, occupancy, ARR, and RevPAR, is marginally higher than the absolute number that has been shown. On the demand side, we have taken out here the economy or the budget segment, as the majority of our rooms portfolio is in the upper upscale or in the luxury. And if you look at upper upscale and luxury, they've had the highest upside when it comes to demand growth versus the supply growth. So we have been well positioned to capture and have a higher utilization of those kind of growth figures than maybe the other brands operating on the subcontinent. Unblocking our brandscape, I think we said that our brand architecture was a bit more than Taj, because it's a normal phenomenon in emerging markets. You take the highest brand and you all like to be associated with that one. So somehow, some fault of our own management, our own colleagues, some of the market, some of other stakeholders, everybody likes to call us the Taj Group, which we are a part also of the bigger Taj Group. But if you actually start using all these brands as businesses and try to reimagine and ask yourself, what if in 10 years I have in each of these restaurant brands, I've scaled them up to 20, 25 restaurants. Can I spin it off? Can I have better brand recognition? Can there be better customer value proposition? Is there a higher loyalty level? Are you dividing the loyalty between Ming Yang, Golden Dragon, House of Ming, etc., right? So these are all very strong brand names in themselves. The time has come to use the potential and scale them up. So we are doing it very successfully, for example, with Bombay Brasserie outside of India. We have one in Dubai. We have one in London. We have one in Cape Town. We will be doing one in Heathrow. And very soon we'll be doing one in Bentota in Sri Lanka. And the same on other businesses. I mean, I come in a minute to Taj Sats and to Ginger, so you will see what's happening. Taj, typically palaces, resorts, safaris, business hotel in upper upscale to luxury segment. Undoubtedly the best. In many forums I've said, if you ask anyone in the world, name me two brands from India, then they would say, it's Gandhi and Taj. Right? And so we are very privileged to have that. They might mean Taj Mahal, but that's the name they know. So Taj, we are very well positioned. We don't need to do anything on that. We just need to make sure we don't do anything wrong with it. That's the most important. So, and it will keep going higher and higher. Selections is a new thing that we have created. We have talked about it, or we had to talk about it, because we took part in the bidding process for the Connaught Hotel in the Lutens, or the Connaught Place in Delhi. And before somebody started writing about the Connaught will have small rooms and if this is right for Taj, we had to let the cat out of the bag, saying that we have a plan to have a named collection. Selections is just a named collection, a collection of generic names, where each of these names is powerful than another brand name. So we have hotels like the Ambassador in Delhi. I grew up within that 1 kilometer area of the Ambassador. And I tell you, when I was growing up, we called it the Ambassador, and we went there to a restaurant called Dasa Prakas. So we said, we're going to the Dasa Prakas in Ambassador. Until date, everyone that I know in Delhi calls it the Ambassador. We can try to be more Catholic than the Pope by calling it Vivanta, by Taj, Ambassador, whatever, but it will stay the Ambassador. The same is in President in Mumbai. The President is the President. For people, the Taj in Colaba is the Taj Mahal Palace Tower in Colaba. The Taj President or Vivanta by Taj President is not a formula that works going forward. So let's not try to be very scientific, use these names, and that's how the idea of selections came up, in order to have a kind of a brand which allows a lot of effort that has also been made by families. You see the picture of Siddhartha Goa there, established for 40 years by a family who have two sons, they didn't have a daughter. And when we signed the contract, the lady said, this is the daughter that I did not have. In all these 40 years, I nurtured, grew up, looked after her like my daughter. So I'm giving our daughter to you. Right? So the importance of the name is significant in the minds of the consumers, in the minds of your owners, in the minds of your stakeholders, and it is very important to maintain that. So that's where selections comes in. Then Vivanta. Vivanta is going to be our modern, nice, upper mid-scale, upscale, upper upscale sometimes if needed, but mainly in the upscale segment or upper mid-scale segment, depending on the size of the city, depending on the size of the market, depending on the quality of demand that we have there. But very, very modern, very different to what you've seen about Taj. Ginger, we revamped and relaunched Ginger under the able leadership of Deepika Rao, who was introduced by Giri. And on the 10th of December, the first hotel in its new avatar was launched in Panjim in Goa. And I think people have liked it very well. I was informed yesterday that there was another owner, potential owner, who went to see this and was thinking of other brands also in Goa for another property and decided to go for Ginger. And this is a brand, I think, to watch, because especially in the Indian context, if that number of citizen and the number of rooms of 8,900 per available room, if that number is going to come down, as said by Paul Slattery, right? That's the kind of vision he has, and he's very experienced, I can tell you. So he's right, but it will not come down with the luxury brands. It will come through brands like Ginger or brands operating in similar category. And for us, Ginger is in the lean lux category. And in order to grow this brand significantly, we identified a project on a land bank that we have near the airport, in front of the Sahara Star or the Ibis property. We have, for since 20 years, we own a piece of land where there used to be the old flight kitchen, and we will monetize on that. That's a part of our strategy, monetizing on our assets, especially underutilized assets. And this is a rendering of how that would look like. Almost a 400-room Ginger that is going to be taking charge of bringing about the renaissance of the Ginger brand. And we will like to do at least 4 to 5 such Gingers in the 4 to 5 most important metros of India, whether we partner with someone, we lease with someone, or we do management contract. But here we were blessed, this is our land, we can decide ourselves. Then some pictures on the launch of Ginger in Goa, which I just talked about, to give you a flavor of how Ginger could look like, because a lot of us have only the impression of Ginger at some train station in Nizamuddin or God knows Shadra or whatever it is. I haven't seen those, unfortunately, but this is also how Ginger could be in that segment. Colorful, vibrant and lively. With that, I come to something which has also been in our industry a difficult subject to discuss. See, when I joined hotel business in the 80s, so in 81 I went to hotel school, 84 I finished, and had a normal run. So in the 80s and in the 90s, if somebody was not considered good enough for the hotel, he was put by every hotel chain parked into the flight kitchen business, because that was less customer facing. But over the years, as the airlines have evolved, we talk about more than 20% growth in airline traffic. So it's an important business. And Taj has been very blessed to get a partner like SATS, which is one of the very successful listed companies in Singapore, and working with the state of technology that they have, that we think there is a lot of hidden potential in this business. You'll hear more and more about this within a week to the next, like let's say 8 weeks or so. Certain announcements, we first want to make them internally to the staff before making it here in public. So there are certain new things that we're doing there, but already we can be happy. It's about selling culinary art in motion. That's number one. It is about serving 65,000 plus meals in a day. It is about having 42% market share of all meals served in the Indian subcontinent on a daily basis. The question is, how do we get to more than 50? Because in this business, the margins are smaller, and the higher percentage share you are, the less resistant you are to the price. So I think this is a very important part of our business, and we are considered undisputedly the number one in this business in India. With that, I come to expressions, and expressions is an umbrella for all the other activities that we do. One of that is food and beverage, to which I just talked about. We have 380 plus restaurants, and we have within that 2 Michelin star restaurants, one in London, one in San Francisco. And it is 40%, food and beverage is 40% contributor to our consolidated revenue. So when we report our results and we talk about consolidated revenue, food and beverage is 40%. If we took India alone, then it is 47% or higher, because of the strength of the wedding business that we have. right? So this is a very important part of our business. We have been always considered, if not the best, among the best when it comes to food and beverage. We would like to believe that we are the best, but let's say we are among the best. Some amount of humility sometimes helps, especially with equity analysts and investors. So, and then a brand like Chambers. Chambers has the highest membership fee and the highest amount of waiting since years. And we're going to simplify the process of Chambers membership. We're going to simplify the whole procedure in how we work, and we'll be relaunching Chambers in the next 2-3 months with different uniforms, with different styles, different kinds of facilities. You know, there were days when we used to talk in any industry about a shop in shop. There will be a Chambers in Chambers for people who are members. There are, rooms for 4, rooms for 6, room for meeting for 8. You have a steam room, you have a room to sleep for a few hours, you have a room to take a snack, whatever, and all other value propositions that are already there, right? An automatic upgrade or a room to wash and change. So I think this is really an important one to watch, because not only people take pride in first introducing themselves. They don't say, my name is Vijay Thakur. It's not, I'm just giving as an example. They say, I'm a member of Chambers for 30 years, and my name is so. It never comes, my name is so, and by the way, I'm also a member of Chambers. So it's that kind of pride associated with this brand, and we want to help our current members and also the new members to take it to a totally different level. Jiva Spas, 65 plus spas, another 30 or so odd salons. I think that's another huge opportunity we have. As people grow more and more towards wellness, people are more and more conscious about looking good, and people are more and more conscious about, as Vijay said this, not having the fat in the middle, right? So I think this is a great business also, and we're working on this to take it to the next level. It's already very successful, and I would encourage all of you to use or at least try out the spa which we have recently launched at the Taj Mahal Palace Tower in Colaba. It's really one of the best available in any city hotel of India. You could have one somewhere in some mountains or some resort, but to have it in the city hotel in the most expensive location in Mumbai, such a spa is an absolute experience and delight. With that, we come next to Khazana. That's last not least. It's been there for a long time. We're going to revive this business also and consider this as a shopping business, what it was supposed to be. But the important message here is very simple. When all these brands were launched, their purpose was to serve the Taj. Over the years, they have matured so much, and they have lived their life that you can make businesses out of them, which we have never thought that way. And this is where our management is very focused on, and that's why we give them a new umbrella of expressions. And this we announce to you today. As we speak, the press release will be going out. We are entering into the business of homestays and plantation trails as alone within our group. We have several hundred guest houses, bungalows, etc., which can provide a special stay, especially to our loyalty members, to our Chambers members. And this would be one of those, and it fits in very well with the expressions. It's express yourself and express yourself always. So you could go with a family or 2 families or 3 families, take on a bungalow in Coorg or in Assam or wherever over an extended weekend, and we are not investing any money in it. Our current infrastructure would manage that. So our GM of Coorg, as an example, would take care of 5 of the 9 bungalows that we are taking over as of 1st of March, or Prabhat, I think it's 6, 5 or 6, right? Total is 9, but the one GM will take care of 7. And Chikmagalur will take care of 2. Then we are ourselves, we own 2 houses under IHCL, and those houses are being redeveloped in Kandolim area called Briganza House and Cardoso House, which will also become into homestays. So you can see that there's Ama Trails and Stays with Ama Plantation Trails and Ama Fine Homestays. I think that gives us a good diversification platform. On the strength of our network, we have 178 hotels portfolio, of which 148 are in operation, approximately 22,000 keys. And as we can see, post-migration of the brands, 77% of our portfolio will be divided among our two mainstream brands, that's Taj and Ginger. The rest will come. As and when we do our third, fourth, fifth Capital Market Day, we will keep you updated. But as things stand today, over the next 18 months period, these percentages are going to change only marginally and not substantially. Very strong domestic presence in a lot of states, very important states. If you want to refer to Vijay's charts, I think we are almost a market leader in NCR, where we have around 17 plus hotels in NCR. We are having some very big machines in Mumbai. We are an absolute market leader, undisputed market leader in Goa. And if I was to hear the other part of the speech that he said, leisure destinations, resorts, holidays. Who has the highest resorts in this country? Of course, Taj. Who created Kerala? Of course, Taj. Who created Goa? Of course, Taj. Who's created a new destination like Andaman? It's us. So I think we are very well positioned or hedged with a balance of business hotels and resort hotels, so that if one was down for one or the other reason, or the holiday season is kicking in, all we have to do is to focus on targeting and getting a higher share of consumers and achhe din and achhi raatein in our resort portfolio. So I think that's very good. And also there is a shift in our business model. We said we wanted to have a more balanced portfolio, and with a balanced portfolio we meant having not all owned and not all in the holding structure. We wanted to have a healthy kind of amount of management contract business. And as you can see, management contracts have grown from 32% to 38% of the portfolio, and the group companies is down from 45 to 41. It's somewhere this margin expansion is going to come from, and all these small things will add up to that 50% increase in our margins. Development has been a key focus. Suma Venkatesh and our team have been working very hard to drive owner relations, taking use of this brandscape, and just go get out and get the job done. And I think we had guided all of you doing 15 contracts a year, and this year I come to those numbers, but more importantly about the asset right or asset light or asset heavy. We guided for the first time that we will use a very simple principle of SMART, which is used in almost all industries with different connotations. So for us in our industry, S would be strategic. If there is a strategic asset in a key metro like Delhi, Mumbai, Bangalore, and it needed some form of investment or some form of, like we call these days, skin in the game, then we are there. We have the means, we have the resources on our own strengths as IHCL to do that, and we will do it. We've done it for Connaught, and we will do it for more, if needed. However, strategic is not good enough. Ideally, it should also be margin enhancing. So anything that helps us to improve our margins. So whenever we try to make these investments, we will try to structure it in a way or form that they enhance our margins. Then it comes with the asset management feature. So Connaught bidding was for 85 rooms. I give one example. We have ended up with 104 rooms plus a floor of office. Everyone is looking at a percentage, which you don't put in a bank. At what percentage did they get it? At what percentage? No, it's by taking out all those services, creating a shared service project, which Giri is leading, for all the hotels that we own, like the one in Dwarka, the Taj Palace, the Taj Mansingh, the Ambassador, the Connaught, having one back of house. Why each hotel should have their own laundry? So when you take out all these things, suddenly you release a lot of space. When you release a lot of space, suddenly space is available for more rooms. And then similarly, if you streamline the services of having one restaurant, one bar, not too many fancy meeting rooms here and there, you also create space for offices. And renting offices in a location like Connaught Place is a no-brainer. The question is only how much rent will you get? But that it will be empty, I don't think so. So, I don't think that situation is coming soon in Delhi. So the next thing is the R, that is building our relationship. What we are doing with all of you today as an investor community, building our relationship with all our stakeholders. When you're growing the organization in any form, whether you're growing in top line, whether you're growing in an investor community, whether you're growing in terms of number of dots on the map, you have to continuously build your relationship. And the T stands for tracking. You continuously track. What did you say? What did you actually do? Where were the gaps? And what can you do to fill those gaps? So that's a very simplistic way of putting what we said. And now, to this year, we have already signed year to date 20 new properties. And you can see that the columns on both Taj and Ginger are pretty long compared to selections of Vivanta, because this is where we are going to focus in the short term. Right. So 20 contracts, approximately 3,000 keys. I think very good news. And some view of our new openings. That's in Udaipur, Shimla, and Kathmandu. And this doesn't include, like Katra, we took over a hotel from another brand. Why it doesn't show is because it's still undergoing some property improvement plan before it can be branded as Vivanta. So actually it's 4 keys total of more than 400 rooms. If this was the year of accelerated signings, next year will be the year of both accelerated signings but also openings. So you don't open much if your pipeline is dry. So the more you put in the pipeline, the more the likelihood of more hotels coming out of the pipeline. So I think next year will be a very important year to watch in terms of the number of hotels we'll be opening. Always iconic, and I think this is very important for us. It's a part of our strategy to be the most iconic and most profitable. And these iconic assets are absolutely amazing and excellent in the kind of service they offer. It's like, I would say, second to none. I have lived in a few countries in the world, and I've worked with other international brands. I tell you, I have not seen anything. And we are very proud that this year we were able to put an end. So every company has 5, 6, 7, 8 challenges, right? So at least we can very proudly say 2 of them were solved and dealt with, and the other 2 are being solved as we speak, and maybe then there are a few left, but in the meantime one or the other will come. But then we or another company would be the only exceptional company in the world which had no challenge at all. And I think that's why managements are needed. If everything was fantastic, everything could run on autopilot. So here a little glimpse on securing and retaining our crown jewels, which the press wrote a lot about, one of those, and the one which nobody wrote about but I thought was the most photographed hotel in the world, and another one, a crown jewel in the south. So with that we come to the operational excellence. I think this is something which has been reflected in our results. A continuous drive by both Prabhat Verma and Rohit Khosla with their teams in terms of employee engagement, guest engagement, margin enhancement, to get from the same store. Look at the demand change is very small, but when you look at our operational performance, it's much higher. So, and it's not some kind of a short-term cost cutting or anything. It's just getting higher market share and streamlining our costs in terms of stopping wastages through process excellence. So I think a lot has been done there. A lot is being also undertaken because there is no end to it. So safety and security is one of those key initiatives. We have had, unfortunately, one or the other not so nice incident in our hotels. We need to improve on that. But the guest experiences have been great. Revenue management has been a top focus. Cost optimization, not cost cutting, has been also a key focus. Exploring synergies within the group. Procurement, we put in projects. I think Giri will talk about one of that in his part of the presentation. And also working on something that is getting very expensive, like fuel light power. Together with Tata Power, we are exploring synergies. And also, we hired Siemens to help us with 20 odd hotels to get this expense. And this hotel is the one which has been done by Siemens, and we saved a lot of money on fuel light power with the help of Siemens. Then, seventh time, we were Gallup Great Place winner. Workplace winner, 16.4% gender diversity and 80% retention ratio. 80% is good, 7th time winner is good, 16.4 is not good, but this room with more ladies present today gives me hope that the number by the third capital market day should at least exceed 20% going forward. A lot of stuff, because without culture things don't work well. We have been communicating to our staff about our values, which you see on the first poster, about touchness on the second poster. What do you understand in all of these buckets? It's put in all hotels, all back offices, so that the communication level is very clear and transparent. Leveraging technology, we have launched the indianhotels.com as a new website, which is very good. We have launched a new intranet for all our staff. We have launched the new website, tajhotels.com, the relaunch of the Ginger with the new brand architecture, and the next two that are coming on the 11th of March, let's say plus minus, no, I would say plus, there's no minus there, 1 week for selections and then followed ultimately by Vivanta. We're working on mobile apps. Mobile apps is not for palaces to open through your mobile phone the key. I don't think we have those guests who want to go to a palace room in Rambagh Palace or Lake Palace and use mobile phone to open the key. But for brands like Ginger, Vivanta, it's a very useful tool. And we do a 360-degree customer analysis, also on the metrics on how we are doing. So a lot of emphasis on data. I think data is going to become more and more important, and the faster we are on board, the better it is for our group. This is my last slide on this year-to-date financial performance. As you can see, year-to-date for the first 9 months, the growth in revenue or the top line is 10%. The growth in EBITDA is 27%. There is, I would not say percentage because it doesn't mean much here, but our PAT till the end of third quarter is 162. For the last full year, we had posted 101 after many loss-making years. And our EBITDA margin is up by 230 basis points, so let's say 2.3. We all know that Q4, together with Q3, is where the industry makes money. Q1 and Q2, if you break even or if you do a bit better than break even, is also considered good. That's what historically has been the case. So mathematically, having January behind us and more than half of February with only 6 weeks to go for the year to end, I do not see any reason, unless there is some big surprise that we don't know of, why we should not be able to deliver on our promise of margin expansion that we have shared with all of you. Thank you. And now I would like to invite Giri to walk you through the rest of the presentation. Thank you.
Yeah. Thank you. I think this is a hard act to follow. So I think I come next to the financial section, and as usual, I'm the last speaker most of the time. Turn around to profitability, and I think what we are trying to do is to make sure that we demonstrate consistent performance with strong fundamentals. And this is just a recap in a slide in terms of what we just announced in terms of consolidated results, in terms of 10% growth in top line, 27% growth in EBITDA, and a significant jump in the PAT on consolidated numbers. Similarly, in standalone numbers, which the market looks at as well. I think the journey so far, this is something that I always reflect since the time I joined, and we kind of talk about it internally actually. I think if you look at, kind of try to look at it from 2015-16 to now, we looked at it from 3 or 4 parameters, 4 or 5 important parameters. Number one was the industry uptick. Where were we in terms of industry? The balance sheet strength of the company. The strategic clarity in terms of how we want to define the path going forward, the delivery of performance, and the development momentum. So we took these 5 factors, and in 2015-16 we were still going through our challenges in terms of performance, and in 2015-16 I think we had all this was kind of in a place which had yet to improve actually. Come 2016-17 we saw the green shoots in terms of industry uptick. The balance sheet strength was still not there. Strategic clarity in terms of our aspirations were not well defined. Delivery of performance was still yet to be demonstrated. Development momentum continued at whatever pace it was earlier. In 2017-18, the industry uptick was more visible. Balance sheet strength, because we did the rights issue and recapitalized the balance sheet with 1,500 crores. The balance sheet strength improved to the strategic clarity came because we announced our aspiration 2022 in terms of what we want to do in terms of strategic clarity. Delivery of performance improved in the previous year, and development momentum started to slowly happen actually. And today, where we are, is that the industry uptick is very visible, as you heard from Vijay and others, and what we see now. The balance sheet strength continues, and this is something that we'll continue to watch. Strategic clarity continues in terms of aspiration 2022, and you just heard Puneet talk about the continuation of the strategy and kind of refining it and taking it forward. The delivery of performance kind of continues, and we sort of hope to sort of keep focus on it and maintain the momentum. And the development momentum, 20 contracts being signed, is a demonstration of the development momentum. So I think now all the engines are beginning to fire, and now the challenge before the management team is to make sure that we take advantage of the hospitality upside and the economy upside that we heard, and continue the work in terms of driving the performance on all these parameters. And this is just a repeat of the chart what we put up last year. And as we look at year 1 of the aspiration, we have now seen the performance, 9 months performance come up, and this is just reflecting where we are. Aspiration now comes to the important part in terms of what did we say in terms of aspiration 2022. We said that we will grow margins by 8%, and we broadly guided that on the revenue parameters it will be about 3 to 4%, and on cost parameters it will be about 3 to 5%. And obviously that's a question which all of you keep asking me as to how you guys are doing about it, and this is what we are also trying to track quarter on quarter. And broadly there are 2 buckets here, one the revenue bucket and the other is a cost bucket. On revenue bucket, clearly, so if I go to the revenue bucket, clearly this is just a snapshot of what we are seeing here. This obviously reflects multiple things here. Clearly the industry coming up, the demand supply gaps existing, and of course the leadership position that we have in the many segments that we operate. F&B revenue, as Puneet said, is very strong here. This chart shows how strong we are on F&B revenue as compared to the room revenue, almost equal, 40 to 45% depending upon whether you look at consolidated or standalone. You see the RevPAR growth at around 6.3%, which is now driven not just by occupancy of 1 or 2%, but we also seen the pricing come up in the last quarter to about 4.5% or so. We are seeing that. International, this is of course exchange adjusted, but if you see that international performance is also kind of coming up actually. So on the revenue side, I think we are doing a lot of work, and with the tailwinds, we hopefully are starting to demonstrate the momentum that we are getting on the revenue side, which is helping us with the 3 to 5% guidance that we are giving in terms of margin expansion. On the cost side, we have, what we call a SCORE, which is Strategic Sustainable Cost Optimization and Reengineering. That's a project which we have, that's a name that we want to give, where we're trying to look at all costs actually. No cost is out, and as Puneet said, cost optimization, where we're looking currently at around 1,500 crores of cost at network level across the different legal entities. And that covers the whole range of costs, whether it is raw materials, power and fuel, stores and supplies, part of selling costs, etc. And on manpower separately, we're looking at things like shared services and synergy across units. And what we are trying to do is on all the levers. It is not just the price. It's not just procurement saying that I'm buying today at 10 rupees and tomorrow I'll buy at 9. It's not just the price lever. That's of course one important thing. The consumption lever as well. We're starting to look at consumption levers as well to see what we can do in terms of optimizing consumption levers. Simplification is another thing. Like if you look at a hotel, we may have any number of SKUs on wine as an example. That's just an example. So how do we simplify the SKU structure will automatically help in terms of inventory optimization and therefore margins. Digital solutions, I think that's an area where we are starting to make some progress. Overall, I think Project SCORE is going to be an important thing. It is work in progress, and you will start seeing hopefully the benefit of that coming through on the cost lines as we go along. But between the two, revenue focus and SCORE, we hope to start driving the margins up actually. Improving returns, obviously this is a question which all of you keep asking in terms of, where are we in terms of not just margin expansion, but also return on equity and return on capital employed. That's obviously a very clear area of focus for us. We have a historical balance sheet, and that historical balance sheet is something that will take time in terms of sort of reorganizing actually. But nevertheless, I think what we are trying to do is to make sure that as we look at all our initiatives and we drive our business forward, we kind of keep focus in terms of improving returns. This chart was there last year as well. The first part of it is a simple DuPont chart. And the first part we discussed in terms of improving net profit margin, in terms of what we are doing in terms of driving margins and costs. The second thing is really asset sweating in terms of our development approach. You saw the movement gradually towards smart approach to development, management contracts, etc. Focus on core assets. ROC is clearly a very important thing. Optimizing renovations. I think renovations, for instance, take this hotel as an example. Historically we would have probably spent 15-20 lakhs per room actually, but today we're distinguishing between renovations and refurbishments. So we are saying that if some rooms don't need a full renovation, but we can do refurbishment at 2-3 lakhs a room, that's good enough actually, and that's fine. Which means that we are kind of optimizing renovations to what traffic can bear in terms of what we can drive through, and so we're trying to get smarter about renovations as well. Managing leverage, that's an area where we are trying to constantly focus on, given our historical experience, and the market continuously keeps asking us in terms of how do you manage the leverage, how do you manage the growth. I think the question is, if you're growing, how will you ensure that you have a sustainable balance sheet, and is a question which keeps coming back to me all the time actually. So leverage is something that we will closely watch. Simplifying IHCL structure, we alluded to it, we have a complex structure. Clearly some of the unlisted entities, some entities we've kind of shut down. Those are all small entities, but doesn't matter. Even if you've shut down 5 legal entities, that does save a lot of costs. Some of the bigger thing where we have listed partnerships and all that is not the easiest, and that is something that we'll continue to pursue. And as we kind of make any progress, we'll kind of talk about it. Optimizing partnerships, because as we are growing through partnerships, and therefore focus on partnerships becomes important. And monetization, we talked about it, and I'll talk about it in a minute actually. I think one of the things that we spoke about is the fact that it's not just about the hotel, it's about now the whole focus on the ecosystem actually. Our core focus will obviously continue to be on the hotel sector, which is the key driver for top line and margins actually. But if you look at the ecosystem that we have, whether it is the Chambers, the Jiva, the Khazana, the Travel Desk, the F&B concepts, etc., I think we already have latent assets. And the latent assets have not been exploited adequately so far. Any portfolio in any of these companies, I always classify as revenue drivers and margin drivers actually. And some of these are significant margin drivers. When we say we have 2,000 members, nearly 2,000 members in Chambers, who pay 20 lakhs in terms of say membership fees actually. Just 35 members will give us $1 million of additional. It's a very hidden latent asset actually. So the point is that there will be those margin driving assets, and starting to work on some of these latent assets will help us on our path in terms of both revenue and margin expansion. And as we also said, we also have market share drivers, SATS, 42% market share. So therefore the portfolio itself, how do we sort of holistically look at different parts of the portfolio and create an ecosystem which taken together help us drive revenue, help us drive margins, help us drive market share, and take us towards our ambition actually. Asset management, just a quick word on asset management. Clearly we are focused in terms of capital allocation in a sensible fashion. Contract management, building synergies, because I think historically we have built in a certain way. An example, Ginger had a sales team, the Taj team had a sales team. Now they're starting to work together, and that synergy itself will kind of ensure that we optimize the manpower there and kind of drive better businesses actually. Customers, for instance. Earlier a Ginger person would look at meet the customer, and the Taj person also meet the same customer. Now such synergies enable us to make sure that there is a focused customer management as a result. Unlock capital, and I'm coming to it in a minute. Clearly we are looking at unlocking capital as well. I think optimizing balance sheet is something, as I said, people ask in terms of how do you manage growth while making sure that your balance sheet is kind of optimized and not again sort of blow. How do you kind of ensure that our ROCs and ROEs are kind of improved upon? There's been a lot of work which has happened over the last 3-4 years. Clearly 2015-16 was significant in terms of our debt equity ratio at 1.65 and our debt to EBITDA of 6.47. So between 2015-16 and today, there's been significant progress made in terms of driving down the net debt to EBITDA of about 2.33%, and we are now saying that we should target towards somewhere a little less than 2, 1.99 is what we talk about in boardrooms as well as internally, and that is a focus area, and obviously we will continue to focus on that. Similarly, the debt equity ratios as well. This is just an example of how this has happened. Essentially, the business growth has clearly been there in terms of EBITDAs. The divestments have helped in terms of correcting the balance sheet and kind of providing the cash, and equity issuance has happened. So we have tried to work on all the levers, and these will continue to be a part of how we kind of grow. One of the questions that, one of the things I like to talk about is how do you optimize the balance sheet? The funding is a continuum really. As we grow, there will be parts of the business which will be in management contracts, which will be low on capital requirements in terms of what we want to do. On the other side, we will do greenfield projects like the Santa Cruz Ginger, which will take maybe 200 crores of cost, where we will have to deploy our own balance sheets actually. But in between, there will be monetizations which will help us release some capital. And we've already started to demonstrate our intent in terms of some of the monetizations. We had a marginal property in Visakhapatnam, which was part of the OHL portfolio, earning us maybe 4 crores in EBITDA. We sold it for 120 crores. That has enabled OHL to sort of reduce debt. And we have 2 or 3 others we are talking about in terms of potential such monetizations. What we are saying is that there is no need for us to own some of these assets in these secondary, tertiary cities which have significant asset values but do not have earning values. So we will continue to explore opportunities in terms of monetization, which will also give us the capital in terms of funding our growth actually. The second is land bank. We've spoken about it. Obviously, land bank is a slow progress. I think what we are doing with Santa Cruz Ginger is one example of monetization, which means that a latent asset doing nothing on the balance sheet, we're using it to create a productive asset. Some we have trying to put on the block, and hopefully we will generate some monies out of it. But this takes time in India in terms of land. But nevertheless, I think this is something which continues to be a focus area. Sale and lease back, we're exploring sale and lease backs because I think it does make sense, and again in the secondary cities, to sort of kind of sell the asset but take it back on lease so that we don't have the hassles of asset ownership, but we are also present in the market and giving us the full P&L benefit. So we are exploring sale and lease back, and we will come back to you shortly with some progress on this actually. Exits of non-core assets. Clearly, we've spoken about some residential apartments we have put on sale. Hopefully, I think we have announced it because the board approved it, and we have sold 3 or 4 residential apartments. Hopefully, by March, we will sell 3 of them, which not big monies at this stage, but I know we have 133 properties actually in terms of residential apartments where our employees stay. And over a period of time, as we start selling it, we should unlock some capital for us actually. We're also exploring strategic partnerships. The other way of optimizing balance sheet is to get into partnerships with people who may help us sort of build our footprints actually. And given the leadership positions that we have, there are different players, whether it is developers or whether it is funds, who are quite happy to sort of work with us, and some of those we are exploring in terms of partnerships. In fact, so this is something that we'll talk about more. In fact, did one transaction where we bid for 2 properties in Hyderabad. This public information on an NCLT bid, where we partnered with a fund called SSG Capital actually, and that's public information. Of course, the bids didn't go anywhere in terms of it's a complex process, part of our learning, but the reality is that it demonstrated our ability to put in a bid along with a fund actually, and that helps us to optimize our balance sheet in terms of getting those acquisitions actually. Approach to funding, again this is a slide from last year, but it's tweaked in terms of the progress we have made. I think what we are saying is that there will be businesses which will be cash generating in terms of low or high, and there will be requirements which are low or high actually. The bottom right continues to be the mainstay in terms of cash, which is the parent company Indian Hotels balance sheet, and that is going to be the driver in terms of supporting the growth. And therefore we will continue to focus on that to make sure that doesn't get diluted, and we will also sweat the balance sheet in terms of monetizations there. On the left hand side, what we are now beginning to see is that the PM, OHL and others are slowly beginning to sort of generate cash, and therefore what we believe is that the possibility that Indian Hotels needs to sort of put any money into these entities, it's remote. US continues to be a big focus area, and we are already seeing benefits in terms of reduction of losses. On the top left quadrant in Ginger, clearly we are repositioning Ginger and we are renovating Ginger. We have recapitalized Ginger with 75 crores and we are exploring a sale and lease back there, which will provide the capital so that Indian Hotels as a balance sheet doesn't have to put more money into Ginger. So that is something we're exploring. And we spoke about the special situations where we did partner with the fund. So this approach will continue to be adopted, it will continue to be refined, but the principles remain the same, that we protect the high cash generating assets, we focus on and make sure that the others also come up to speed in terms of cash as well actually. Our institutional shareholding remains very strong. I think the Tata Group is about 39%. The retail investors are only 13%, which means between the FIs and the DIs, it's about 48% institutional shareholding, which is fantastic. You know, I think with such a strong institutional shareholding, I think we're very proud of it, and also I think the institutional shareholders are demanding in terms of the discussions and the business performance, and what we are really focused on is hoping to make sure that some of you in the room who have invested and some of the international ones who are not in this room come in as long investors and stay on, because hallmarks of good corporate balance sheets is to make sure that you get long only investors who stay with us for a long time. A couple of slides in terms of culture of responsibility and governance. I think very clearly we are committed as a Tata Group company in terms of the highest levels of responsibility and governance. In terms of community connect, we continue to do significant work. The Taj Public Service Welfare Trust, the contributions that we did in the Kerala flood, I think the recent program that we started on Dil Se Dijiye for cancer patients, where people checking out of hotels can kind of contribute to the Tata cancer hospitals. Actually, we continue to do work both on livelihoods, neighborhoods, welfare, etc. We continue to work on that. In terms of sustainability, we are beginning to focus in a significant way in terms of sustainability, in terms of energy use, in terms of water utilization, single-use plastics. I think there's a lot of work which is beginning to happen on sustainability as well. In terms of corporate governance, clearly speaking, as a Tata Group company, we continue to espouse the highest levels of corporate governance, which has been recognized with a few awards in terms of the corporate governance awards. Our balance sheet is changing in terms of what you saw, what we did last year in terms of greater disclosures, in terms of a number of different areas, and that will only improve as we go forward this year. These are some of the awards we won. Our website is improved. The investor page is much more clearer now. We're giving a lot more information on the website. So if you have not seen it, I would encourage you to go and see the information that we are starting to provide on the website as well. Our board of directors remains the pillar of strength for us in terms of the way they guide us and the way they push us as well in terms of driving towards our vision and our aspiration and our performance actually. So they continue to be a strong influence for us. Our leadership team we introduced actually, we remain completely committed towards the aspiration and the performance towards that aspiration. And a recap, and this is a bit of creativity. In fact, the entire presentation followed the acronym here of foundation, where we said we have an aspiration which we defined last year, and as we sort of work through, we will continue to sort of focus on all of these in terms of working on our strong fundamentals, building on it, and driving towards the aspiration in terms of the networks, the top lines, the profitabilities, and our leadership position. Thank you. What I would do now is to sort of, I just wanted to say that we had employees watching our webcast. At this point, we will kind of switch off the webcast and give us a minute. We'll just put some chairs here and then we can take questions. Thank you. Okay. Okay. May I request the ExCom sort of come in?
Yeah.
Thank you. Thanks. Yeah.
Very good.
Thanks.
Renu, Deepika and
Deepika?
we'll have
Yeah. Deepika and
eight.
Sagar?